Hello and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we are very pleased you have joined us for our banking conference. Our next live presentation is from QNB Bank. Please note you may submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings by clicking Book Meeting in the top toolbar. At this point, I'm very pleased to welcome Dave Freeman, President and Chief Executive Officer, and Jeff Lahaki, Executive Vice President and Chief Financial Officer of QNB Bank, which trades on the OTC markets under the symbol QNBC. Welcome, Dave and Jeff.
Thank you. Appreciate that. First of all, I just want to thank the folks that are here in the meeting with us today. We appreciate you taking the time to hear our story. We think we've got a good story to tell and look forward to talking with you and answering any questions that you have. So you see our vision and mission. These have probably been the same since the strategic plan was worked on over 20 years ago, first put into play. And we really believe this is how we want to do business and how we look at our business. And we always try to take those four constituencies I mentioned in the mission there in mind as we're making decisions. And we feel that's been key in allowing us to thrive and to continue to stay independent. We have a great success story about our employees. We have 4 senior vice presidents and 1 executive vice president that started this bank out of high school. Not too many places with 200 employees can say that. It just talks about our long-term employees. We try to always be balanced in our decision making with these constituencies. We think that's going to serve our needs in the long run. So we've got tremendous stability here. As we mentioned, we have a lot of long-term employees. We're definitely a growth-oriented company. We're always looking to figure out ways to grow. We've done a great job of taking advantage of market disruptions. A couple of things have happened over the last 7 or 8 years when BB&T purchased NatPen, now Truist. We pick up $86 million in loans in the first year, and that's the kind of thing we do. We picked up some great employees when Bryn Mawr was purchased by Wispas. So anytime those kinds of things happen, we take advantage to grow the bank, to pick up clients as well as pick up key employees and pick up talent. So that's something we've done consistently. Management team overview. I think one of this is also a great strength for us. We've got a great mix of veterans, people that have been here, midterm like me, and then some new folks. We've really had some great people come into the organization, as well as our great long-term employees here. We think that's given us the opportunity to take the best of what we had, and then take the people from outside with new ideas and new ways of thinking and new ways of doing things. That's worked out well for us. Core market overview. We're in great markets. Bucks and Montgomery are 2 of the collar counties around Philadelphia. They are great strength there. Meds and eds are key throughout that area, as well as in Lehigh Valley. Lehigh Valley has seen a big growth in distribution, and that's led to job growth there. And all 3 of the communities that make up the Lehigh Valley, Allentown, Easton, and Bethlehem, have all seen renaissances and great growth. And I think we closed about $80 million of loans in that market last year. So it was a great opportunity up there. And we see the markets we're in as having great diversity and great resilience in times of recession. And then we've got a bank and corp overview there. We really have. I'm just going to start talking about the numbers here right after that. But you can see we have a nice group of branches, have good connectivity between the branches. But we're not, as we looked at newer branches, we're not being as close as they were in the past. We feel like a 5-mile radius is kind of perfect. We don't have any current plans to add to the branch system right now, but we're always looking for opportunities, and there are some markets in the counties we serve that we'd like to be into if we find the right opportunity. With that, I'm going to turn it over to Jeff Lahaki to talk about the numbers. Jeff?
Today, this page here shows our financial performance from 23 to 24. I would characterize 24 as a great rebound year. 2023 was a difficult, was responding to higher interest rates. In 2024, though, we really turned the page and have rebounded in a big way in terms of our balance sheet growth and our profitability. So with respect to earnings, higher interest rates negatively impacted interest income by $4.3 million in 2023 on the top right of your page. However, as interest rates moderated in 2024, net interest income rebounded by $2.7 million. So we recouped more than half of what we lost in just 1 year. Credit quality has improved significantly over the last 3 years. And core non-interest income has generally been stable, what you'll see on the bottom right-hand side of your screen. The volatility in non-core interest income is due to 2 factors. Mark-to-market on a small equity portfolio. It's a portfolio we ultimately exited in 2024 because we wanted to remove volatility in future earnings. And the second factor is in 2023 in particular, we took the decision to strategically offload some of our available for sale bond portfolio, took some losses on those positions, but we've reinvested the proceeds from those sales at much higher yields than the bonds were previously generating. Turning to the balance sheet, as I mentioned before, we had tremendous growth. And that's been sustained over a period of time, both in terms of loans and deposits, both sides of the balance sheet. Notably, growth really accelerated in 2023, and then accelerated yet even more so in 2024, where we saw 10% growth in our assets. Recognizing those opportunities for growth, we took the decision to issue $40 million of sub-debt in September of 2024. That's increased our regulatory capital, and it really positions us well to be able to take advantage of future growth opportunities. Capital ratios have been solidified by the sub-debt. You see the ratios here on this page. At a consolidated level, our total risk-based ratio increased from 13% to 15.5% in 2024. You see that in the bottom right. And we've pushed the sub-debt down to the bank, resulting in significant improvement in all bank capital ratios. Turning to loans, loan balances have doubled over the last 10 years. However, half of that growth has occurred in just the last 3 years. And credit quality has also improved significantly over the last 3 years to exceptional levels. Our loan portfolio is well diversified. No segment represents more than 26% of the total portfolio. The effective duration is generally short. Mortgages have a duration of approximately 6 years, and commercial real estate has a duration of approximately 2 years. Important point to note, we have no exposure to inner-city office commercial real estate. And finally, the portfolio is well structured with strong collateral. Asset quality is strong. Non-performing assets and net charge-offs are very low. You can see that in the top right and in the bottom left. And also, if you look at the bottom right, reserves are very high relative to non-performing assets at really 3 times. And we are proud to be outperforming the average of our Pennsylvania bank peers on all metrics you see here on this page. Turning to deposits, our portfolio is well diversified with very low concentration. Disintermediation out of non-interest bearing deposits leveled off in the latter part of 2024 As a result, non-interest-bearing deposits have been stable now for the past several months. Also worth noting, uninsured deposits are very low. Only 17% of our deposits are either uninsured or non-collateralized. In terms of the mix of our deposits, core customer deposits have consistently accounted for about 97% of our portfolio. Our core deposit ratio is higher than the average of Pennsylvania bank peers, which in the latter case has been falling over the last 3 years. And as I said, we managed to maintain our core deposits at a high percentage. Also, the cost of our interest-bearing liabilities is 26 basis points lower than peers, an advantage that has been expanding over the past 2 years. This slide compares changes in our funding costs versus changes in Fed funds. So the orange line is Fed funds, the blue line is our cost of interest-bearing deposits. In the current interest rate cycle, represented on the right side, our cost of interest-bearing deposits has increased at roughly half the rate of the increase in Fed funds. This has resulted in a 213 basis point funding advantage for us, which is higher than 162 basis point advantage that we had in the prior cycle on the far left-hand side of the page. Here we cover asset and liability spreads. The rate received on assets minus the rate we pay on deposits stabilized in 2023. And the spread has been steadily increasing since the middle of 2024, where we're now back above 200 basis point spread. The increase in the spread is due to new loan growth and rolling 5-year rate resets on our existing loans, as well as the cost of funds coming down at the end of 2024. A few observations on efficiency and net interest margin. Expenses as a percentage of assets continues to be relatively stable at about 1.5%. Growth in assets has enabled us to make necessary investments in our infrastructure, which is an important factor in remaining viable in community banking. The decrease in net interest margin in the fourth quarter of 2024 was due to the impact of the sub-debt issuance that I referred to earlier. It's important to note that we have neutralized the expense of the sub-debt with income from new investments. However, the increase in assets results in a modest decrease to net interest margin. As noted earlier, net interest margin is increasing. Net interest income is increasing. Finally, we conclude with a look at our stock performance. As was the case with other banks, QNBC stock traded lower as interest rates rose in 2022 and 2023. However, as our financial performance improved in 2024, QNBC stock has traded higher. And further stock appreciation has continued thus far in 2025. That brings us to the end of our presentation. Let's take some questions.
Great, Jeff. Thank you. We have any questions from the audience? We'll be prioritizing those. We also had a few questions that we wanted to go over just to get some additional information. Let's see. I'll get those questions to show up here. Let me see here. So first of all, how do you anticipate credit quality develop in 2025? I'll start with that question. We feel like we're in good shape in terms of how we've really kept our underwriting standards throughout. We haven't backed away from those. We have good structure on our loans. Obviously, if you get in a recession, there's always things that happen in terms of unexpected issues, but we feel like we're well prepared to deal with any of those things that come up. We're in much better shape. If we did have a recession, which you don't expect at this point in time, the market's not predicting, we feel we're in much better shape going in this recession than we were in the last one. So we learned our lessons and have been really strong about keeping our credit culture strong as we've seen growth over the last couple of years. We do have some questions from the audience. 2025 plans for dividends and buybacks. I'll start that. Jeff may have some color there too. We did increase our dividend in the first quarter, so we anticipate doing that through the rest of the year. Jeff, I'll let you address the buyback issue.
Yeah, I think the way we're looking at how we utilize our equity is our first priority is to grow and to grow our assets and grow our business. So, we're focused on organic growth. We certainly keep our eye on what's happening in the M&A market. But as long as there are profitable opportunities to leverage our capital by growing the bank, we'll do that. If those opportunities don't exist, then we'll take a look at buybacks. It's important that our shareholders generate a return on their investment.
We also have another question from an audience member. Does your bank need to consider taking any measures to mitigate risk associated with potential changes in U.S. trade policies? We do have a significant number of manufacturing clients, and obviously they're going to get impacted by the tariffs and also supply chain disruptions that maybe result from the tariffs. So that's something we're definitely keep our eye on. I know the last time there were steel tariffs, we had a customer that buys only U.S. steel, and unfortunately, the U.S. steel companies typically use the occasion to raise prices. They did not use an opportunity to take additional market share. But the good thing is because of all the disruptions from COVID, a lot of our manufacturers have more resilient supply chains. They've gone to different overseas suppliers or have multiple suppliers. So I think because of COVID and everything that happened there, they're probably better prepared for any disruption from tariffs than they would have been prior to COVID. So that's a good thing from that side. We have another question as it relates to the session. You mentioned your ROA and efficiency ratio. Jeff, you want to talk about ROA and efficiency?
Yeah, our ROA certainly took a hit in 2023 from the impact that higher interest rates had on our profitability. But we've seen our ROA improve in 2024, I guess by about 10 basis points. We're in the 0.60 percentage range. And so as long as we continue to grow our profitability, we expect ROA will continue to follow. Sorry, Dave, I can't see the second part of that question. Efficiency. Yeah, so again, profitability down in 23, our efficiency ratio was a bit higher at about 75%. We saw about a 5% decrease in 2024, down to roughly 70%. We expect that we'll continue to see improvement in that ratio as we grow in profitability. But coming back to the slide I spoke to earlier, we like to look at expenses as it relates to as a percentage of our assets. And with that ratio of expenses to assets, we've maintained a consistent level at about 1.5%.
Thanks, Jeff. I have another question. Do you have an appetite in M&A? How do you view tangible book dilution payback period? You have a sense there's pretty heavy competition for deals in PA. We have had a change. We were not in the M&A business, not in the acquisition business previously, and our board, when we met last summer to talk about our strategic planning, they have given us the go-ahead to look at acquisitions where it makes sense, in our market areas or reasonably within our market areas. So we have started that process. looking for the right opportunity. We much prefer to do a negotiated acquisition as opposed to a sell the highest bidder acquisition. We think that's the best for them and best for us. So that would be our first shot at that as we're looking for. We definitely have some opportunities in our area with banks that are much smaller than we are that we think there might be some opportunities there. So we're continuing to look at that. I mean, Jeff and I and the board, we haven't really had one we've looked at that we've really made a final decision on what we feel about payback. I think in our internal discussions, we would lean toward a 3-year payback, I would believe, is where we'd be comfortable. In the right circumstance, perhaps a little longer, but that would be our preference. Competition, it's hard to say. I mean, what's you see definitely for some of the smaller organizations, the big banks just aren't interested in buying somebody that's $500 or $600 million because they just don't have the appetite there. So that takes the Folds out of the world. The public announced no one looking at anything less than $1 billion. And now obviously larger banks are only looking for a very large deal. So I think the competition has probably declined to some extent. A lot depends too on what the bank that's being acquired is looking for. They're trying to maintain some of their employees, or what's their interest in that. So I think that'll vary depending on the target. I don't know if you have any other color to add to that, Jeff, or not.
No, not really, Dave. Obviously, you highlighted on earn back. We're very focused on dilution and earn back, as well as the price to tangible book. So we're monitoring deals that have been done over the last 2 years. So we have a sense for what the going rate is, if you will. But to Dave's point, we're not going to make any deal. If the economics for us don't make sense.
Another question, can you give more detail on the sub-debt offering? Jeff, you want to talk about that a little bit more?
Yes. So last summer, we raised $40 million of sub-debt. We had originally planned to raise actually a much smaller amount. But the appetite was very strong for our paper. So I think we were 3 to 4 times oversubscribed. And so we ended up taking a little more capital than we initially had planned. And the rate that we settled on is actually a little bit lower than what we were originally expecting. So we were very pleased with the sub-debt offering. It was very well received by the market, and it's really helped buttress our capital ratios, particularly at the bank level, which is where we obviously hold all of our loans and deposits.
Yeah, we were really encouraged by the market's response to that sub-debt issue. Jeff and I were both pleasantly surprised with that. I had a question about any regional headwinds for 2025. Other than the disruption, I think just of the kind of back and forth on the tariffs and companies trying to adjust to that, particularly our manufacturing clients. Other than that, market's very strong. The rental market's extremely strong. New home building is going very well. We have a number of subdivisions we finance, and they're all selling homes more quickly than they anticipated. So that continues to be strong in the greater Philadelphia market as well as the Lehigh Valley. So we don't really see anything right now as of any grave concern to us. So we feel pretty good about what's going on in the local economy. We have a couple other things here. Changes in the regulatory environment with potential impact on banks. It's an interesting thing because it's kind of a double-edged sword for us because we have a lot of people focused on compliance. We're definitely a belt and suspenders organization when it comes to compliance. We have a great record of meeting all the requirements of the regulations. And as we prepare for things to happen, and then all of a sudden you get whipsawed, that's not going to happen. That can be challenging at times. But overall, we feel like there's a good opportunity to step back, and the people that are talking about being appointed and the ones that have been appointed as acting heads have much more of a understanding that you can't have regulations the same for a $1.8 billion bank as you have for JP Morgan Chase. So hopefully we'll get some relief there. The CRA Act is one of those that just, they issued a new reg. It's thousands of pages long. We hope to get some relief on that. We think we do a great job of serving the credit needs of our community, and we'd like to focus on that without a lot of the other the things that are in there that don't really make sense for community banks. We're hoping we expect overall to be a significantly improved regulatory environment for the next steps, next several years. QNBC has a somewhat high AOCI that will be earned back over time. Does this impact how you look at things such as doing a securities restructuring and potential buyback? Jeff, I'll let you take the lead on that one.
Yeah, and similar to many banks, we have a pretty substantial bond portfolio that's low yielding and underwater from a unrealized mark-to-market basis, and that mark-to-market sits in AOCI. So we've been watching the market, looking at long rates, and there have been several instances where we took the opportunity to sell some of those bonds, take a loss, but we only did so when we knew that we could reinvest the proceeds and earn back that loss in 2 years or less. We'll continue to look at that. The long end of the curve hasn't necessarily been cooperating of late with fears of inflation. So we'll continue to monitor to that, but we will absolutely take the opportunity to restructure that portfolio to the extent the opportunities become available.
Another question about what are the expectations for 2025? We saw over the last year and a half, a lot of our community bank competition has stepped away from lending, reduced just to kind of steer clear of CRE loans, period, or reduce the dollar amount they were willing to do. And that's part of the reason we had such strong loan growth last year. Right now, it looks like that's still happening. So if that does, that would bode well for us. The other thing we have a lot of most of our commercial real estate loans that are longer term have a 5-year fixed rate period. We have a significant number of those loans that are coming due for their 5 years rate set change, and those loans are coming off at the high 3s, low 4s, and coming back on towards 7%, sometimes over 7%. So that's also a positive note. Technology continues to be a challenge. We continue to have costs there we have to incur. So that's probably the most challenging thing, is to make sure that we have a significant enough growth on the revenue side to afford to continue to invest in technology. That's key for us. One more question. We have a few executives who are nearing retirement. Do you have succession plans in place to support the organization? We do update our management succession plan every year, present that to the board every December. We feel like we've got good succession plans at every place. Obviously, in the key executive roles, we most likely do a search and interview both internal and external candidates when the time comes. I think we're almost out of time. I think that was the last question we had. So again, thank you all for being with us today. We really appreciate that. And certainly, if you ever have any questions about our bank, feel free to reach out to Jeff or I. We're happy to meet with you and spend some additional time with you one-on-one or both of us together. Have a great day, everyone. Thank you.
Good day.